Right now, supply and demand zones are among the most popular ways of trading the markets. This is especially true in forex. In fact, you've probably even heard of them. But what exactly are supply and demand zones? In the next several minutes, you're going to learn the background of these technicals and how to apply them in your very own trading approach. Now, before we go any further, let's talk a little bit about supply and demand. The concept of supply and demand is not new. It's an economic theory credited to economist Adam Smith in 1776. This concept is as old as the hills. Basically, the theory states that when there's a difference between the supply of an asset and the demand for said asset, the price of that asset moves. Now, I'm going to spare you the economics 101 lesson. We are traders, we're not economists. What you need to know is this. When there's an imbalance between buyers and sellers, price changes directions. It's that simple. When a balance of buyers and sellers is reached, the market establishes an area of equilibrium. It's also been called an area of fair value, whatever you want to call it. These areas are now known as supply and demand zones among traders worldwide. So why are supply and demand zones useful? This is where things get interesting. They're used by price action traders to establish technical support and resistance areas on the trading platform. Once these areas are identified, a decision to buy or sell the market is made. All right, let's head over to the charts, and I'm going to show you exactly what I mean. All right, one of the best things about supply and demand trading or supply and demand zone trading is it's easy. It's relatively simple. Executing the trades is relatively simple. Finding the supply and demand zones is nuanced, but after a little bit of time, you're going to be able to find these things on pretty much all time frames. I would just, a word of warning, the smaller the time frame you get, the tougher spotting these zones can be because price action has a tendency to get choppy and just not move. So that would be a quick disclaimer. But if you follow these 5 steps, you can find a forex supply and demand zone and really boost your efficacy in the market right away. So let's take a look at your 5 steps. Number 1, you identify pronounced highs and lows on your chart. Okay. Number 2, you're going to search for areas of consolidation that are sort of in the vicinity of those highs and lows. Number 3, you're going to locate price spikes. Now, price spikes used to be called swing highs and swing lows, but as you see, as we go through, as the years pass and different trading methodologies are introduced to the publics, the nomenclature changes. So locate price spikes. I've called them swing highs and swing lows for a long time, but we're going to show you what a price spike is here in just a second. Number 4, add additional indicators for confirmation. That is huge. That's one of those things where you can really boost the efficacy of your supply and demand zones just by adding an indicator. It could be an oscillator, it could be a Fibonacci, it could be a moving average, it could be anything. It could be anything you want. It could be a chart pattern. So definitely something to look at there. And then lastly, stay up to date on central banking activity. If you are going to trade the Forex and you ignore central bank activity and fundamentals, you're destined to fail. I would highly recommend understanding when those key events are and what bearing they can have on the currency pair you're trading well ahead of placing a supply or demand zone trade. Now, what is it? We're going to look at this chart and show you how to trade this chart in just a second. But before we do, understand what a supply zone is and what a demand zone is. Supply zones act as resistance while demand zones act as support. Now, you'll see supply zone. Where is it? Typically, it's above price. It's above price action. You're working off a periodic high. Why is it a supply zone? Why would it be resistance? Because there's more sellers than buyers there. Hence, you're located towards the top, top of a periodic range or a swing high or a swing low. What's a demand zone? A demand zone is going to mean there's more buyers in there than sellers. You're going to be located near a periodic swing low and potentially be the base point or a bottom of the market. So remember that resistance, support, more sellers than buyers, more buyers than sellers. That's fairly intuitive. I think you guys probably all grasp that if you've been in the market for any length of time. All right, so how do we trade this thing? Very quickly, I mean, it depends on who you talk to. They're going to give you a bunch of different ways to trade it. I'm going to give you a relatively simple way to trade it that's relatively intuitive. Now, take a look at our supply zone, for instance. Now, if we're looking at this supply zone, potentially we want to get short. Why would we want to get short? We believe that the periodic swing high, the top of our market's in. So we're going to base this trading decision on this zone itself. And that's going to be really the basis for our trade. So if I'm looking to trade this thing, I'm saying, okay, there's my spike high. Remember step 1, we're identifying upper extremes. And then we sort of have an area of consolidation right in this zone. You'll notice that the daily ranges, it's a daily Great Britain pound chart. The ranges get a little bit tighter and you're moving sideways. So now we want to trade this thing. And what I would recommend is just going right at that bottom of that supply supply zone, looking at that as being a potential area of resistance. And you're going to put in your limit order, your sell limit order, and you're ready to rock and roll right there. So right from the bottom of your supply zone. Now, one thing that I would highly recommend is understanding where you need to get out of this trade if it does not work. And for me, it's relatively simple. You're going to be going right up here to the top of your supply zone, right above that swing high. I would recommend really cushioning that a few pips and being able to take, at least make sure that you don't just see a 1 or a 2 tick takeout and then a reversal. That happens a lot. You could also put your stop loss above a big round number. Right here, you're at 135.34. You could go up and just put it right up above 135.50 to give yourself a little extra room just in case life gets tough up at that swing high. So that's how you would execute the trade. And we're reverse engineering this to sort of show you the concepts. But take a good look at what you have right there. You have a pretty good strike of really the bottom of your zone, and potentially you caught an incredible bearish move. Now, once again, this is historic data. It is easy to make money going to the left on these charts, but that does give you a good illustration of the mechanics of exactly what that kind of trade is. Now, on the flip side, look at your demand zone. Our demand zone's pretty much the opposite. We've got sort of a swing low down here. You'll notice right here, you've got a consolidation area, and then you've got a spike low, and then you've got some more consolidation until you finally get a bullish break. So this consolidation down here would be your demand zone. Now, if I wanted to execute that trade, relatively basic, relatively straightforward, we're just going to be looking to really add an order right there, and you're going to be looking at buying this limit order right there, or until elected, arrest, anything you want to call it, depending on your platform. And you'll notice right there, you're going to look to buy this market. Why are we buying the market? Because it's a demand zone. The idea is that there's more bidders in there than there's sellers, and price is going to go in our favor. Now, as a quick illustration of, let's say we have a demand zone here and a supply zone, a predefined one. We could be putting our profit target really anywhere that we wanted. We could be looking for maybe half of this move, half of the range up to the supply zone, or we could just say, hey, listen, I've got my stop loss loaded beneath this demand zone right here, and I'm just going to play this thing until we get back up to supply. That's one way of trading it. A lot of traders do that, and they look for the big risk versus reward payoffs, and that's just fine if that's the kind of trader you are. Some folks just believe in taking a little bit less on their trades to have a higher winning percentage. Ultimately, that's going to be up to you, dialing in risk versus reward. Feel free to tune into a couple of live streams. We'll show you how to do this in real time as the market's moving, but for all intents and purposes, that's going to be a function of how much money you have, how much risk you want to assume, and what your profit targets and your goals are for your trades. So that's a quick look at how to execute trades based on supply and demand zones. Basically, that's all there is to it. With very, very little experience, you can get up to speed on how to do that. The real nuance and the real challenge comes on identifying these zones on shorter time frames, and also in chaotic, choppy price action in market conditions. That can also be extremely difficult. So once again, it's doable. If you want to go down this road, feel free to do some research, check out a live stream, and see exactly if this type of methodology is for you. Demand zone, supply zone, balance and imbalance. Are you confused? Don't be. With a little practice, you can master identifying areas of supply and demand. The bottom line is this: when there are more buyers than sellers, prices rise. When there are more sellers than buyers, prices fall. Identify the areas of balance near the extremes of the move in price. Then you built your supply and demand zones. Sell supply and buy demand. Dial in your risk versus reward ratios, and then you've done it. Now, one of the best things about this methodology is truly its simplicity. Of course, it pays to understand that nothing is foolproof. No matter how you trade, if you do not practice proper risk management, then you are destined to fail. And that's just a fact of life in the markets. Now, if you're looking for market access, give the Switch Markets link below a click. And be sure to subscribe and check us out on the socials. As always, trade well, and we'll see you in the markets.